If someone handed me $1 million today and said, your only job is to protect it from the next market crash, I wouldn't do what most people expect. I wouldn't run to gold, I wouldn't hide in treasury bonds, I wouldn't stuff it under a mattress or move it offshore. I would do something far more strategic, something most people completely misunderstand about wealth preservation during crises. There's a fundamental difference between protecting wealth and hiding from risk. Most people think protection means avoiding all possibilities of loss. They think it means sitting in cash, buying insurance, or finding an investment that only goes up. But that isn't protection. That's paralysis. And paralysis has costs you only see when it's too late. True wealth protection means positioning capital to survive the crash, continue generating returns during it, and emerge ready to compound again. It means owning assets that bend but don't break. It means having liquidity to seize opportunities when others are panicking. Crashes aren't just threats, they're opportunities for those prepared. I've protected capital through 14 major market crashes over 70 years. I bought my first stock in 1942 during World War II when the future of civilization was uncertain. Since then, I navigated the Kennedy slide, the brutal bear market of 1973-74, Black Monday in 1987, the dot-com collapse, the 2008 financial crisis, and the COVID crash of 2020. Each time, I not only protected capital, I used crises to build more wealth. Let me share a story from 2008. The financial system was teetering. The housing market was collapsing. Banks were exposed to mortgages that would never be repaid. Derivatives created risks no one fully understood. I didn't know exactly when the crisis would hit, but I knew the conditions were dangerous. I built cash reserves, avoided companies heavily exposed to housing, and focused on businesses that could survive anything. When Lehman Brothers collapsed that September while others panicked, I was ready. I invested in Goldman Sachs and General Electric at terms almost unfair, but possible because I had cash when no one else did. Those investments generated billions. This is what crash protection really means. Not hiding from risk, but positioning yourself to thrive while others falter. So, how would I protect $1 million from the next crash? Let's break it down. 1. Cash is not failure, it's ammunition. I'd keep 20 to 25% in cash or short-term treasury bills, $200,000 to $250,000 ready to deploy. Crashes make quality companies available at discounted prices, but only cash can buy them. Investors fully invested heading into a crash are paralyzed. They can only watch. Cash gives you freedom to act. 2. Own high-quality businesses that survive anything. I'd allocate roughly 50 to 55% in forever stocks, companies selling essentials people need regardless of economic conditions, consumer staples, healthcare, utilities, insurance. Businesses with strong moats, consistent cash flow, conservative balance sheets, and proven dividends. They won't double overnight, but they survive crashes, pay dividends, and compound wealth. High-quality businesses share 4 traits: essential products or services. People don't stop eating, filling prescriptions, or using electricity during recessions. Strong competitive moats, brand loyalty, cost advantages, or regulatory protections ensure dominance post-crash. Consistent free cash flow, dividends continue, giving income even when stock prices fall. Conservative balance sheets, manageable debt levels let them survive revenue shocks. Examples: toothpaste, packaged foods, medical devices, utilities, and insurance. These businesses may not be flashy, but they protect and grow wealth reliably. 4. Dividend income protects psychology and builds wealth. During a crash, portfolio values fall, but dividends keep coming. They provide psychological stability, helping investors avoid panic selling. Reinvesting dividends buys more shares at lower prices, compounding returns when markets recover. 5. Avoid fragile investments. Avoid leveraged companies, unprofitable growth firms, concentrated revenue streams, complex structures you don't understand, and speculative momentum trades. Crash survivors focus on resilience, not hype. Fragile investments crumble when conditions change. 6. Maintain the right mindset. The biggest losses in crashes come from emotional decisions, not the market itself. Have a plan. Check fundamentals first. Deploy cash gradually. Don't try to time the exact bottom. Rebalance. Sell what holds up. Buy what falls most among quality holdings. Document decisions to maintain discipline. History proves this works. 1973-74, the market fell 50%, recovered massively. Patient investors flourished. 1987, the market dropped 22% in a day and recovered in 2 years. 2000 to 2002, the dot-com collapse wiped speculative stocks. Quality dividend stocks recovered faster. 2008, financial crisis caused 50% drop. Cash and quality stock buyers made fortunes. 2020, COVID crash fell 30% in weeks. Recovery was swift. Crashes are inevitable. Recovery is inevitable. Quality survives, patience wins, panic destroys. Protection isn't avoiding risk. It's survivability, optionality, and discipline. It's matching your portfolio to goals and time horizon. If I protect $1 million, I'm not just preserving capital, I'm growing it. Cash buys opportunities, dividend stocks compound wealth, quality businesses emerge stronger, and I sleep knowing my financial foundation is secure. The next crash is coming. I don't know when or how severe, but if you're prepared, you won't just survive, you'll thrive.